हेलो नमस्कार। खुश रहो बच्चों। आई एम JV'n डॉक्टर शाहनवाज आलम, असिस्टेंट प्रोफेसर of Jyoti Vidyapeeth, Women's University, Jaipur. Today we discuss about most important concept of money banking and public finance. Today topic is tax incidence. Tax incidence or incidence of tax is economic terms for understanding the division of tax burden between the stakeholder, such as buyer and seller of producer or consumers. Tax incidence can also be related to the price elasticity of supply and demand. When supply is more elastic than demand, the tax burden fall under the buyers. If demand is more elastic than supply, the producer will bear the cost of tax. The tax incidence depict the distribution of tax obligations, which must be covered by the buyers and sellers. The level at which each party participate in conferring the obligation shift based on the associate price elasticity of the products or services in question, as well as how the product or services is currently affected by the principle of supply and demand. Factor determinant of tax incidence: elasticity. Considering the incidence, we consider both elasticity of demand and elasticity of supply. If the demand for a commodity taxes is elastic, the tax will be tends to be shifted to the producer. But in case of inelastic of demand, it will be largely borne bear by the consumers. In case of elasticity of supply, the burden will tend to be on the purchasers, and it's in case of inelastic supply on the producers. Second factor is price. Since shifting the tax burden can only take place through the change in price. Price is very important factor. If the tax levies the price unchanged, the tax does not shift. Next most important factor is time. In short run, the producer cannot make any adjustment in plant and equipment. If therefore demand fall on amount of price rise resulting from the tax, he may not be able to reduce supply and may have to bear the tax to some contest. In the long run, however, full adjustment can be made and tax shifted to the consumers. And next, tax cost. Tax raise the price, rise in the price reduce demand, and reduced demand result in the reduction of output. A change in the scale of production affect the cost, and effect will vary according to the industry and decreasing, increasing, and constant cost of industry. For instance, if the industry is subject to decreasing cost, a reduction in the scale of production will raise the cost and hence price, shift the burden of the tax to the consumers. Nature of tax. The incidence of taxation will be definitely depend upon nature of tax. For example, indirect tax burden fall on the consumers. Market forms. Another factor determinations the incidence of taxation is the market from under perfect competition. No single producer or single purchase can affect the price. Hence, shifting the tax in either direct is out of the question. But under the monopoly, a producer is positioned to influence the price and the shift the taxes. In next chapters, we will discuss about effect of taxation. Thank you.